3 missiles fly across the night sky in the Middle East. Iran launches. Israel responds. News alerts explode across phones. Most people see geopolitics, military tension, another chapter in a conflict that feels far away. But on Wall Street, something else happens. Oil traders lean closer to their screens. Insurance companies quietly adjust risk models. Defense contractors see their stocks move. And inside the US Treasury, the numbers start shifting. Because every time Iran and Israel move one step closer to conflict, the United States starts losing money, not millions, billions, and sometimes far more than that. The strange part, most Americans never notice it. There are no dramatic headlines saying, U.S. economy just lost $50 billion because of Middle East tension. The losses are quieter than that. They show up in oil prices, shipping costs, interest rates, military budgets, global trade routes, small movements that quietly drain enormous amounts of money. So the real question is not whether the Iran-Israel conflict is dangerous. The real question is this: why does a regional conflict thousands of miles away keep punching holes in the world's largest economy? And why does the US keep paying the bill? To understand that, we have to start with something surprisingly simple. Oil. Because despite all the talk about renewable energy and electric cars, the global economy still runs on oil. Ships need it, planes burn it, factories rely on it, supply chains depend on it. And oil markets don't care about politics. They care about fear. The moment a conflict threatens the Middle East, traders begin pricing in risk. Not actual damage. Risk. If missiles start flying near major oil routes, the price moves instantly. Even if no oil infrastructure is hit. Even if production doesn't change, fear alone can move the market. And Iran sits in one of the most sensitive positions in the entire energy system. Right next to the Strait of Hormuz, a narrow waterway that handles roughly 1/5 of the world's oil supply. Every day, about 20 million barrels of oil pass through that single corridor. Picture a global highway for energy squeezed into a 21-mile-wide channel. Now imagine missiles flying nearby, or drones, or naval confrontations. Oil traders don't wait to see what happens. They react immediately. Prices jump. Sometimes $5 per barrel, sometimes 10, sometimes more. Now here's where the uncomfortable math begins. The United States uses roughly 20 million barrels of oil per day. So when the price jumps by just $5 per barrel, that's about 100 million extra dollars per day flowing out of the US economy every single day. Over a month, that's $3 billion. Over a year, it can quietly reach tens of billions. And that's just from price spikes. But oil is only the first domino. Because once energy becomes more expensive, everything else starts moving. Transportation costs rise. Airlines pay more for jet fuel. Shipping companies increase prices. Manufacturers pay more to run factories. Delivery trucks burn more expensive diesel. And those costs eventually land somewhere very familiar. The consumer. Groceries get slightly more expensive. Flights cost a little more. Online deliveries quietly increase in price. The economy doesn't collapse, but the pressure builds. Inflation creeps upward, and inflation creates another problem for the United States. Interest rates. When inflation rises, the Federal Reserve usually responds by tightening monetary policy. Higher rates, slower credit, more expensive borrowing, which means mortgages cost more, car loans cost more, business loans cost more. And suddenly, a conflict on the other side of the planet is affecting whether someone in Ohio can afford a house. But oil isn't the only channel draining money. There's another one: military spending. Whenever tensions rise between Iran and Israel, the United States quietly moves military assets into the region. Carrier strike groups, missile defense systems, surveillance aircraft, naval patrols. Each deployment costs enormous amounts of money. Operating a single aircraft carrier group can cost around $6 to $7 million per day. And when tensions escalate, multiple groups may be positioned nearby. Add fighter jets. Add logistics. Add missile interceptors. Add intelligence operations. Suddenly billions of dollars are being spent just to maintain deterrence. Not war. Deterrence. The goal is to prevent the worst case scenario. But prevention is expensive. Then there's defense aid. Israel receives billions in US military assistance every year. Missile defense systems like Iron Dome, precision munitions, air defense interceptors. When conflicts intensify, those supplies are used quickly, and replenishing them costs money. A lot of money. Missile interceptors alone can cost tens of thousands of dollars each. Some advanced systems cost hundreds of thousands per shot, and every time rockets fly, more interceptors are required. The irony is almost absurd. In some cases, a homemade rocket costing a few $100s triggers a defensive response costing tens of thousands. Multiply that thousands of times, and the bill grows fast. But the economic ripple effects don't stop there. There's global trade. The Middle East sits along some of the most important shipping routes on Earth. Energy routes, cargo routes, supply chains connecting Asia, Europe, and Africa. When tensions rise, insurance companies step in. Ships traveling near conflict zones suddenly face higher war risk premiums. Insurance costs jump. Shipping companies raise prices to compensate. And those costs move through the global supply chain. Electronics, clothing, industrial parts, everything becomes slightly more expensive to transport. The numbers may seem small on each item, but global trade is measured in trillions of dollars, so even tiny percentage increases can represent enormous economic losses. Now here's where the story gets even stranger. Sometimes the United States actually benefits from higher oil prices, because America is also a major oil producer. U.S. energy companies sell oil globally. When prices rise, their revenues increase. So in theory, the country gains from the same price spikes, hurting consumers. But reality is messier than theory, because higher oil prices also slow the broader economy. Consumer spending drops, inflation rises, markets become volatile, and uncertainty spreads across financial systems. Investors hate uncertainty, so capital starts moving towards safety, treasury bonds, gold, defensive assets, which means less investment flowing into riskier sectors that actually grow the economy. Technology, startups, infrastructure, innovation slows down, and over time, that lost growth becomes extremely expensive. Then there's the geopolitical balancing act. The United States supports Israel, but it also relies on stability in global energy markets, which means Washington often spends enormous diplomatic energy trying to prevent regional escalation. Negotiations, back-channel talks, sanctions, military deterrence, all designed to avoid a full-scale regional war, because if that happens, the financial consequences become far worse. Imagine the Strait of Hormuz closing even temporarily. Oil prices could spike dramatically. Some analysts estimate prices could surge past $150 per barrel in a severe disruption. At that level, the global economy could slide toward recession. Stock markets could tumble. Inflation could explode. Central banks would face impossible choices. And suddenly the cost to the United States wouldn't be billions. It would be trillions. Which brings us to the uncomfortable truth at the center of this story. The Iran-Israel conflict is not just a regional issue. It's a pressure point in the global financial system. And the United States sits directly inside that system. Every missile launch, every military response, every diplomatic escalation moves markets, moves energy prices, moves capital flows, quietly redistributing money across the world, sometimes toward defense contractors, sometimes toward oil exporters, and sometimes straight out of the pockets of ordinary consumers. The strange irony is that the U.S. spends enormous amounts of money trying to stabilize the region. Military presence, security guarantees, diplomatic leverage, all designed to keep energy markets calm and trade routes open. But the very act of maintaining that stability is itself extremely expensive. It's like paying a massive insurance premium every year forever. Because the alternative might be far worse. So when headlines say, Iran launches missiles, Israel responds, Middle East tensions rise, the real story isn't just political. It's economic. It's about oil flows, shipping lanes, inflation pressures, defense budgets, and financial markets reacting in real time. A giant system shifting quietly in the background. And here's the part almost nobody talks about. The global economy has been built around the assumption that these conflicts will never spiral completely out of control. That deterrence will work. That diplomacy will hold. That the Strait of Hormuz will remain open. That regional wars will stay regional. But assumptions are fragile things, and history has a habit of breaking them when people least expect it. So the real question isn't how much money the United States is losing today because of the Iran-Israel conflict. The real question is something far more unsettling. What happens to the global economy if one day those hidden costs suddenly stop being manageable and start becoming catastrophic?